Crowdfunding. What is it and how does it work? Crowdfunding is a way to raise money from a large group of people. It's like asking a crowd for funding instead of going to a bank or a single investor. People contribute small amounts of money to reach a larger funding goal set by a company. Think of it like this. Instead of one big investor, you have many smaller investors, each contributing a piece of the pie. Platforms like Kickstarter, Indiegogo, and GoFundMe have made it easier than ever to connect with potential investors online. Project creators showcase their ideas and funding goals, and anyone can contribute. Crowdfunding isn't just about money, it's about building a community around your product or idea. These early supporters become your brand ambassadors, spreading the word and creating buzz. Crowdfunding versus private equity, a head-to-head comparison. Let's break down the key differences between crowdfunding and private equity. Source of funds. Crowdfunding casts a wide net, gathering smaller investments from a large pool of individuals. Private equity, on the other hand, involves securing a large chunk of funding from a select few high-net-worth individuals or firms. Investment-size crowdfunding typically deals with smaller amounts, ranging from a few thousand to a few $1,000,000. Private equity investments are significantly larger, often in the millions or even billions. Investment structure crowdfunding offers various models, including equity-based, debt-based, and reward-based. In contrast, private equity firms typically acquire a significant ownership stake in the business in exchange for their investment. Investor involvement crowdfunding generally involves minimal investor involvement beyond the initial contribution. Private equity firms take a more active role, often securing board seats and influencing business decisions. Who can tap into the crowdfunding pool? Crowdfunding isn't just for tech startups or creative projects. Businesses across various industries can leverage its power. Here are a few examples. Startups, seeking seed funding to get their innovative ideas off the ground. Small businesses, looking to expand their operations, launch new products, or reach new markets. Real estate developers, raising capital for property development projects. Nonprofit organizations, funding social impact initiatives or community projects. Essentially, if you have a compelling story and a clear plan, crowdfunding can be a viable fundraising option. Weighing the pros and cons of crowdfunding. Like any business decision, crowdfunding has its advantages and disadvantages. Pros: accessibility, lower barrier to entry compared to traditional funding sources. Marketing and validation provides early market validation and builds brand awareness. Flexibility offers various funding models to suit different business needs. Community building engages early adopters and creates a loyal customer base. Cons: competition. The crowdfunding landscape can be crowded, making it crucial to stand out. Fees. Platforms typically charge fees for their services. Disclosure requires transparency and accountability to a large pool of investors. Execution risk. Successfully delivering on promises made during the campaign is essential. How investors make money in the crowdfunding game. Investors can participate in crowdfunding through various models. Equity-based crowdfunding. Investors receive equity shares in the company in exchange for their investment, similar to buying stock. Debt-based crowdfunding. Investors lend money to the business and receive interest payments over a predetermined period. Reward-based crowdfunding. Investors contribute to a project in exchange for non-financial rewards, such as early access to products or exclusive experiences. Donation-based crowdfunding. Investors contribute to a cause they believe in without expecting any financial return. The potential returns and risks associated with each model vary, and it's crucial for investors to understand the terms before investing. Choosing the right path. Crowdfunding or private equity. The choice between crowdfunding and private equity depends on your business's specific needs and goals. Crowdfunding is a great option for businesses seeking smaller amounts of capital, looking to build a community, and open to sharing equity. It's ideal for early-stage businesses with a strong story and a clear vision. Private equity, on the other hand, is more suitable for established businesses seeking substantial capital for expansion or acquisitions. It's crucial to have a solid track record and be prepared to relinquish some control to secure private equity funding. Ultimately, the right choice depends on your risk tolerance, growth plans, and long-term vision for your business. Choose wisely, and never be afraid to seek expert advice to make the best decision for your unique situation.